Hi, we're TMP Consulting. We're gonna present the case regarding party relations, and we're gonna cover the next topics. We're gonna talk about exchange rates and inflation, the PPP factors that prevent PPP from occurring, interest rates in Thailand, blades in PP, and PP in Thailand. So just to start, we're going to cover one of the issues regarding this case, which is the relationship between the exchange rates and the relative inflation levels of the two countries. And we can explain this as Thailand's higher inflation will ultimately increase imports from the UK to Thailand, while decreasing exports from Thailand to the UK. And we can see this on the graph here. We're basically expecting a higher inflation from Thailand, and obviously the imports from the UK into Thailand are gonna increase, and of course the exports of the UK will increase in the same way. And so for the profits of Plate's company, since we have already learned that their cost of goods sold is basically it's based on the market price, then it's going to fluctuate and it's going to be affected by the inflation, while the revenue is locked in a contract. So basically, we would expect a decrease in the profits, while the cost, as we can see on the graph, will increase. Another of the issues that we want to address in the case has to do with some of the factors that prevent the PPP from occurring in the short run. And to sort of explain this, we want to divide the elements or the factors affecting PPP into two categories. One is going to be the internal the internal barriers. And we can point out technology, infrastructure, economic policy, interest rates, culture, natural resource, education, production cost, and currency, which are strong barriers that prevent Thailand and UK to reach the PPP balance. And so, to the second point of this issue is whether we would expect PP to hold better if countries would negotiate trade arrangements under which they commit themselves to the purchase of sale of a fixed number of goods over a specified time period. And we actually don't think that this would actually help to hold PPP, because the internal barriers are so intrinsic in these countries that despite the fact that you could perhaps overcome the external barriers through trade agreements, you would still be concerned about the internal barriers that obviously impact your cost of goods sold. And then we also want to talk about one of the issues that deals with reconciling the high level of interest rates in Thailand with the expected change of the baht pound exchange rate according to PPP. And to sort of explain this, we would like to talk about a little bit of the international Fisher effect theory, which indicates that currency with high interest rates will depreciate as higher nominal rates reflect higher expected inflation. This means that, as we saw in earlier cases, we have that because of the higher inflation of Thailand, they're trying to mark up their interest rate to attract investors, such that they could remain competitive. And so when we look at the interest rate in the UK, while it's lower, their inflation is also lower, and so these two differences are to be balanced out in theory, such that when an investor is trying to look for a higher profit on a country with higher inflation and higher interest rates, the return they would achieve would be about as high as they would get domestically. So those are sort of the elements involved in the international Fisher effect. And so with that said, I'm going to leave you guys to Tori, which would touch upon some other issues.
So, as Pedro was mentioning, there's several factors that would lead Thailand to be affected by a lack of purchasing power parity. These include transportation costs, tariffs, the fixed investments that a company would need for arbitrage opportunities, impediments to trade flow between two countries, differentiated goods, meaning what's the quality of the goods, what's the brand name of the goods, that type of thing. Non-traded goods, so these could be goods that you can't necessarily export to another country, or services. Since the baht is recently freely floating, we're thinking that it's going to be undervalued, and that purchasing power parity will probably not hold. To illustrate our point, we would like to take a look at the Big Mac Index. Maybe you've heard of the Big Mac Index. It's kind of similar to, for example, the Starbucks Latte Index. We have some data from The Economist from July of this year. Basically, the Big Mac Index looks at whether a Big Mac hamburger from McDonald's is the same price in one country versus another, because as we can agree, the Big Mac hamburger is basically the same product. So a Big Mac hamburger in the US would be $4.07, which the same hamburger in Britain would be 2.39 pounds, which converted into dollars at that rate is $3.89. And the same hamburger in Thailand would be 70 baht, which would be equivalent to $2.35 dollars. So if we look at where the hamburger is more expensive, the hamburger would be more expensive in Britain and cheaper in Thailand, even though it's the exact same good. So moving over, basically what we can see is that although you have an actual dollar exchange rate, this is actually affected if you use purchasing power parity. So according to purchasing power parity, both currencies would actually be slightly stronger against the dollar. But if we compare just Thailand and Britain, we would see that the Thai baht would actually be stronger against the pound, because you can buy the same good in Thailand for a cheaper price than you could buy it in Britain. So should Blades be concerned with the purchasing power parity comparison between Thailand and Britain? We believe that Blades should ask themselves some questions. First, what are the differences in labor costs between Thailand and Britain? We would speculate that Thai labor may be a little bit cheaper, and this could affect their costs in manufacturing their products. Also, what legal barriers exist between the two countries? How easy is it to import goods and export goods? What sort of tariffs are there? What sort of taxes are there? How is this going to affect their profits and their costs? What quality differences exist? As was mentioned in the case, they said that the components they were getting from Thailand were of good quality, but if they were importing components from a country where the quality was bad, this may be of more concern. What economies of scale are present in Thailand compared to Britain? So based on the size and how well equipped the plant is in Britain or Thailand, can one factory produce the product for a cheaper price? Also, what are the differences in transportation costs? As we know, if you need to transport the rollerblades between one country to another, or components between one country to another, this is going to take a bit of time and a bit of money. For high-cost goods such as a cell phone or semiconductors on an airplane, that's going to cost a bit more than, say, for example, a bulk good. So we need to also consider the cost considerations for the rollerblades. So blades should consider all of these factors when making their future plans for their operations in Thailand. Thank you for your attention. Here are sources, and we'd like to ask you to ask us any questions about our presentation. You can find our blog on our webpage.